today's lesson, we are going to go into liquidity ratios. What is liquidity? It is how easily the assets of a business can be converted into cash so that they can meet its short-term debts. We are now going to learn how to calculate those ratios that will show if the business has the ability to meet its short-term debts. And we will start with two main ratios, which would be your current ratio and your acid test or quick ratio. Okay, so today's lesson we're going to be doing the liquidity ratios. It is based off of a PowerPoint lesson by our HOD, Mrs. Gomes. So last lesson we had done the profitability ratios, which mainly came from the income statement, and the relationships were mainly between profit and net sales. So today's lesson we're going to do the liquidity ratios. In the balance sheet, relationships between current assets and current liabilities are used to determine the ability of a business to pay its short-term debts. These ratios are called liquidity ratios. So these are the ratios that we are going to do today. And then our next lesson would be, of course, the turnover ratios. But as I said, today we are focusing on the second set of ratios, which would be our liquidity ratios. So what is liquidity? Liquidity refers to the ease with which an asset can be converted into cash to pay debts when it becomes due. So it is the state of having enough money or assets, liquid assets, to pay any money that is owed, especially in the short term. So the things that the owner may want to know: do I have enough current assets to pay my current liabilities when they are due? If the current liabilities are paid, does the business have enough money left after paying to pay for the everyday expenses like buying more inventory, paying rent, salaries, utilities, etc.? Is there, in other words, working capital? I don't know if you remember, but working capital is your current assets less your current liabilities. So that is what they're talking about. Do you have enough working capital? So do you have anything left over after your current assets have been used to pay your current liabilities? Do you have a positive working capital figure? So it is easier for the business to interpret information in relative terms as X to 1, that is current assets to current liabilities, rather than absolute terms in dollar amounts. So what they're saying here is it gives you a better indication when, instead of just using figures like you're saying the dollar amounts for your current assets and the dollar amounts for your current liabilities, that it is better to show it in a ratio, as in the current assets to the current liabilities. In other words, you will see whether you have enough current assets to cover your current liabilities, which are your short-term debts. So liquidity is the ability to pay short-term debts, which are your current liabilities, and they are based on the relationships between your current assets and your current liabilities. So remember, what we had learned before is ratios are all about relationships between two items in the financial statement. For liquidity, the relationship is between the current assets and the current liabilities, which are both items in your balance sheet. So we have two businesses. We have business A and we have business B. And business A has this amount of current assets and this amount of current liabilities. Business B, $400,250. So which business is better able to pay their current liabilities and have current assets left for working capital? What we have here are just the absolute dollar amounts or the monetary amounts, but we want to put it in a ratio form so that we can have a better indication of whether they have the ability to meet the short-term debts. So ratios are about relationships. And in this case, the relationship that we are going to be looking at, it would be our current assets to our current liabilities. This ratio is basically called your current ratio. So this is the ratio, the first liquidity ratio that we are going to be looking at. And the formula for your current ratio is current assets over current liabilities. As simple as that. And whatever answer you get, this is going to be emphasized over and over again. Whatever answer you get, you have to add :1 because it's a ratio. It's being expressed not as a percentage, not as dollar amount, but as a ratio where you have :1. So that is going to be emphasized. Business A, simply current assets over current liabilities. Business B, current assets over current liabilities. So it's very easy to calculate our current ratio, current assets over current liabilities. And for business A, our current assets of $120,000 over our current liabilities of $60,000 will give you an answer of 2, and you add the :1, so your answer is 2 to 1. So there are 2 current assets to 1 current liability. You come and you do the same thing for your business B. With current ratio, the formula current assets over current liabilities. And the answer :1. So when you have 400,000 divided by or over 250,000, answer you get 1.6 to 1. So that means you have 1.6 current assets to 1 current liability, or to cover 1 current liability. In general, the generally accepted current ratio that is considered good or sufficient, all other things being equal, is 2 to 1. So they usually consider when you have a ratio of 2 current assets to cover 1 current liability, they consider that generally acceptable, right? But it depends on the business and the industry and all that. But this is the generally acceptable ratio. So what you would see is that business A meets that ratio, but business B falls below the 2 to 1, which means that they might look at that as business B, you have a little issue there, or you have to look at your liquidity. So as you can see, based on our answers for business A, they say that business A is more liquid because for every $1 of current liabilities, business A has $2 of current assets. So they have $2 to cover every $1 of current liabilities or to pay their debts. Whereas business B has less. They have $1.60 of current assets to cover that $1 of current liabilities. So you can see from the ratios that business A is more liquid and therefore better able to pay its short-term debts. Just like with the profitability ratios, as much as they give you a better indication, you also get a clearer idea when you can see it visibly in terms of a diagram. So what you see in this diagram, very simply, your green represents your current assets, and you can see clearly that your current assets in both businesses are greater than the current liabilities. So you're seeing that. But how much greater? The current liabilities are in orange. How much greater? You would see that business A is greater. So it's twice as much as the current liabilities. So it can cover. You would see here very, very clearly that business B is less. So that ratio that we had just done is called your current ratio. But there's another ratio for liquidity that gives you an even better indication of the ability of a business to meet its short term loans or debts. So if a business has to pay its current liabilities quickly, then it needs to see how much cash it can get quickly. Now, if you remember your current assets, you have four current assets, and it is in the order of the least liquid to the most liquid. Cash is always your most liquid because liquidity is about converting your assets into cash, and cash is already cash. So you can't get more liquid than cash. So what you're looking at is how much quick assets or the most liquid assets do you have. This ratio takes away the least liquid of your current assets, and the least liquid, or the one that is the most difficult to turn into cash, would be your inventory. So if you have that inventory there, it is not as easy to convert it into cash as the others because you have not sold it as yet. You still have to find buyers, customers for it. So just to get a better idea, in other words, of the assets that you have that are very, very quickly converted into liquid cash, you would take away the inventory to give you a better indication, because inventory is not as easily or is the most difficult to convert. So this ratio, which is your quick ratio, acid test ratio, instead of the current assets over current liabilities like the current ratio, you have current assets less the inventory, which is your least liquid asset, over current liabilities. And just like the current ratio, whatever answer you get, colon 1. So it will be quick assets to 1 liability. This should just be reinforced with, we go back to the current ratio. Current ratio was your current assets over your current liabilities. And the example was, say your current assets was 12,500 over 5,000. Your answer would be 2.5, and you add the colon 1, which means that you have $2.5 worth of current assets to cover the $1 of current liability. Then you have the second ratio, which is your acid test ratio, where you just minus inventory from your current assets. So it's current assets less inventory over the same current liabilities. So for example, your current assets, or your total current assets, was 12,500. Your inventory is 2,500. So we're going to take that away from your total current assets, and you divide it by your current liabilities, which still remains as your 5,000. And the answer you get is 2 colon 1. So 2 to 1, that means you have 2 liquid assets or quick assets to cover the 1 current liability. So here we have a nice little exercise. We have a business A, and on this side we have all our current assets and all our current liabilities. So our current assets, inventory, accounts receivable, bank and cash, and that totals to 120,000. And then we have our accounts payable and bank loan, which totals to 60,000 in terms of our current liabilities. Remember, our formula for our current ratio would be your total current assets. You see your total here, 120,000, over your total current liabilities, and you see your total here, 60,000. So if this is your ratio, you plug in these figures, 120,000 over 60,000, and the answer you will get is 2. Add your colon 1, so you have 2 to 1. So for business A, the current ratio, you have 2 to 1, which is the generally acceptable ratio. Then we will look on this side here, and the difference is for your quick ratio, you exclude inventory because it is the least liquid. So to get a better indication or a better idea, we take this out totally. So what you will have is a total of 60,000 instead. The 120,000 minus your 60,000 leaves you with your liquid assets of 60,000. And then your current liabilities remain the same. It is still 60,000. So remember what the formula was for the quick ratio. It's the current assets. You take away your inventory and you divide by your current liabilities, which would be 60,000 over 60,000, which gives you 1 to 1. So what I didn't mention before is just like you have a generally acceptable, accepted, all other things being equal, current ratio, which is 2 to 1. Your generally acceptable quick ratio, all other things being equal, like type of business and industry and all that, is 1 to 1. Once you have enough quick or liquid assets to cover the current liabilities exactly, that means you have no working capital though. So you have no working capital over. But once it covers the short term debts, they consider that acceptable because it's the most liquid. You still have your inventory that you can get cash from, right? So 1 to 1 is the acceptable for the quick ratio, current ratio. So business A seems to be in the all other things being equal, in the generally acceptable liquidity. They're good in terms of liquidity, in terms of generally acceptable. So here's a diagram. It's showing you how it is. The green is the current assets again. The orange would be your current liabilities. You would see here for the current ratio with a total of the current, you would see that how it's doubled. So it is more. So it's more than covering. It's covering your current liabilities by 2. However, you would see when you take away your inventory and you have just your liquid assets like your accounts receivable, your bank, and your cash, that it exactly covers it. So they're equal, it covers it exactly. This is just showing a breakdown. So once again, the difference between the current ratio and the acid test ratio is inventory. Right? This light green area represents your inventory. So you would see that with the inventory, your current assets is all the way up here at 120,000, and it more than covers your current liabilities, which would be the orange area. However, when you take that away to calculate your acid test or your quick ratio, you would see that it now makes it equal, that it exactly covers the current liabilities. So this is nice little activity for you. We had worked out for business A, and we saw that business A liquidity was around the generally acceptable 2 to 1 for current ratio and 1 to 1 for the quick ratio. We're going to do the same thing now for business B to see what we get for them. Your total current assets would be 400,000. Total current liabilities would be 250,000. So 400,000 over the 250,000 for your current ratio will give you an answer of 1.6 to 1. Always do not ever please just put 1.6. This is a ratio. So you have to, so this represents the current assets part of it. You must put the $1 that represents the current liabilities. And next thing, this must always be 1. You cannot have 8:5 or something like that. That is not how the ratio is expressed. It is always expressed x to 1. So you divide this, you get an answer, and then you put to 1. Always. I do not want to see any other number here but 1. This is the number that you would see all kind of different changes, but it's always 1. You'll see that I'm really emphasizing that. So 1.6 to 1. Nothing else here. Get your answer. 400,000 divided by 250. Get your answer and add colon 1 to 1. Quick ratio, it's the same thing. The formula, however, you're taking away inventory. That's the difference between the current ratio and the quick ratio or the acid test ratio. So we took away our inventory here. The inventory was 100,000. So 400 minus 100 gave us a total of 300,000 over the same 250,000 for your current liabilities. You got your answer as 1.2 when you divided 300,000 by 250,000, and then you add your colon 1, meaning that you have 1.2 quick assets or liquid assets to 1 current liability. For business B, this falls under the 2 to 1 generally acceptable. But you never know if when you look at it, that they might still be okay. You're just saying that generally it is better if it's 2 to 1. But they still have enough to cover its short-term debts. Whereas for the quick ratio, which is the most liquid, they're actually above the generally accepted, which is 1 to 1. It means that they have real liquid assets that can be easily converted to meet its current liability. So they're good with the acid test or the quick ratio one, where they're actually above the generally accepted, which is 1 to 1. That means that they have a little working capital left over, even with when you just take away the inventory part of it. So once again, we see it in a diagram form. This light one here represents the inventory, which is the difference between the current ratio and the acid test ratio. But you will see in both cases the current assets, which would be the gradients in green, still covers the current liabilities, which is in orange. So for business B, their liquidity is still sufficient. Basically, once it's covering your current liabilities, once it's more. If you see that the green is less than the orange, you know you're in problems. It means that you do not have enough assets, liquid assets, to cover your current liabilities, and the business needs to check that. If we had a situation like that where the green was less than the orange, problems. Or this was less than the 1, the ratio here. So instead, if you had a ratio that was 0.6 to 1, that is an alert, something is wrong there, okay? So the users would be like the suppliers, investors, of course the owners, managers who run the business and stuff. They would use these ratios because along with profitability, liquidity is extremely important. In fact, you must have a balance, because the most profitable assets are actually the least liquid assets, and the least liquid assets are the most liquid assets are the least profitable. So they have a inverse relationship. They're the opposites. The most profitable are the least liquid, and the most liquid are the least profitable. So you must strike a balance, because both are very, very important. You cannot just concentrate on profitability. You must also concentrate on liquidity, because you have to have liquid assets to be able to cover your short-term debts. Otherwise, you're going to have to shut down and liquidate and all that, which is something that you can speak to your business teachers about in terms of when a firm has to liquidate, what it has to do. It basically has to sell its assets to be able to get cash so that it can pay its creditors, because the business has to pay its creditors. So liquidity is something very, very, very important that you guys have to look at. Do not just look at profitability. You must also be concerned with liquidity. So along with the profitability ratios, these two ratios are extremely important. So that's it for this lesson. At a later lesson, we're going to do the activity ratios or the turnover ratios. So we already did the profitability, we just did the liquidity, and then we will end with the activity and then put it all together in terms of the ratio calculations.